Yes, so this is a question for December 2022, which was question number 24. The question reads, Bermuda Limited presented the following financial statement for the year which ended 30th of June 2021 and 30th of June 2022. So first of all, we have the statement of profit or loss for the year which ended 30th of June 2022. So we are given the figures here in million of shillings. First of all, we have the revenue, which is a figure for 473. We have the cost of sales 222. Then we have the gross profit 244. We have the gain on financial asset at fair value. And then we have the investment income. Then we have various expenses here, a number of expenses, which include administrative expenses. We also have distribution cost, and then we have the finance. We also have the finance cost. Then from there we have the profit before tax, and I need to confirm these figures because the question is typed. So this 48, this 46, 76, and then this 17, a total of 141, which is deducted from the figure up there, and the profit before tax is 114. Then we have the income tax expense, which is 47, and then we have the profit before tax. And I think we can do away with these particular zeros here. So we just need to highlight everything here. And then we come up here in these reduce, or we do away with those zeros. Yes. So then from there we have the statement of financial position, of which this one is basically given for 2 years. And generally that is the case. Once you're given a question for cash flow, you will be given the statement of financial position for the current year and basically for the previous year, such that whatever you have here, for example, these are opening balances and these are closing what? Balances. So we have the non-current assets, which include PPE, and this is 327,264. And then we have the intangible assets, 40 and 50. And then we have the financial assets through other comprehensive income, 22 and then 10. So and then we have the totals there. Then we have the current assets, which include inventory. Inventory in that case is 123, 176. We also have trade receivables 95 and 87. We have the financial asset at fair value 65 and 30. And then we have the cash and cash equivalent. This one is 29. And actually here should be 0. Should be 0. It is 0 there. Yes, it is 0. 0 like that. Yes, and then from there, we have the total assets. Then we have the ordinary equity. Equity comprises of ordinary shares, 230, 150, share premium 30, 0. Then we have revaluation reserve 36 and 67. And then we have the financial assets through other comprehensive income equity reserve, which is 0 and 2. And then we have the retained profit, which is 121 and 91. Then from there, we have the total equity. From there, we have the non-current liabilities, which include 10% loan stock of 150 and 100. Then under the current liabilities, we have bank overdraft, which is 22. And this one is 0. 0. And then we have the trade payables of 100 and then 156. We have the interest payable of 3 and also of 7 there. And then the income tax payable of 34 and then 19. So I needed to confirm those figures because this question was typed. All of them are correct. Yes, so equally we can do away with these particular zeros here. Yes, yes, we can do away with those figures there. Those zeros, that is. And then we have some additional information about your tool. Property, plant, and equipment held by Bermuda Limited are items of plant and equipment and freehold premises. Then you're told during the year which ended 30th of June 2022, an item of plant and equipment which originally cost shillings 40 million was disposed of resulting to a loss of shilling 6 million charged in the administrative expenses. So, and then you're told that the book value, or sorry, this item, the book value of shillings 28 million at the date of disposal. So we are told the net book value for that asset was 28. Then from there we have the additional information number 2. And in this case, we are given the depreciation charge for the year, which was shillings 43 million. And finally, we are told that shillings 50 million of convertible loan stock were converted into 50 million ordinary shares or ordinary share capital at par value during the year. So what are we required to do in this case? We're required to prepare a statement of cash flows for this particular company, which is called Bermuda Limited, in accordance with IAS 7, basically for the year which ended 30th of June 2022. Recall what we said is that this basically the concept which you covered in financial reporting and also advanced financial reporting. But in this case, we say that what is expected of you now here is to be able to do this particular question using Microsoft Word, Excel. And actually, also what we said is that whenever now you are handling this particular question here, you need to do it, or you need to have your solution in the same Excel worksheet. Don't go and open a different one. So basically what we said here is that you just split this worksheet, that is worksheet into two. Maybe you can split it here. We can split it here. Yes, so we can split it here. And actually we said you need to come here and you can put such kind of a boundary, maybe using such color. So then from there, you come up here. You say that this is your solution. So therefore, it is important to note that you don't have to open a new Excel worksheet. You basically have do your question in the same worksheet. And actually, in this case, we can also make this to be a little bit clear by bolding it. We say to bold this one. You can either come up here, you bold, or you can just say Control B like that. Control B. So then maybe we can also make it also a little bit clear that this is our solution. Now, before we prepare this particular cash flow as required, maybe we need to have some few workings as per the information which are given in the additional information. So I think number 1, we are given information about PP. And I think what is important is what you're given from sentence 2, whereby we are told during the year which ended 30th of June, an item of plant and equipment which originally costed shillings 40 million were disposed of, resulting in a loss of 6 million, which was charged in the administrative expenses. And in this case, we are told that this item had a net book value of 28 million at the date of disposal. Now, here, as far as this item which was disposed is concerned, you can see we are given its cost. We are given the loss now which was reported on the disposal, and also we are given the net book value. There is something the examiner has not given us here, and that is the sales proceeds. So that is the first thing we need to compute here, the sales proceeds for this item. So this item of plant and equipment, it was sold at how much? So let's start by computing that one. That will be now, actually we can start now here with the workings. We say that these are the workings, and basically we start with the working 1, which now will be to compute the sales proceeds of the plant and equipment. Now, generally, what we know is that when computing the loss on disposal, that is the loss. Actually, we can say when computing the gain stroke loss on disposal. So what we do, we take the sales proceeds. Sales proceeds in this case, recall, is the amount at which an asset is sold at. Sales proceeds. Then to this we less the net book value. And this net book value, you also have to recall, it is also known as the carrying amount. It's also known as the carrying amount. Is also known as the carrying amount. Case, we are told that this item is the sales proceeds here. So therefore, the loss is how much? The loss, as per the addition information number 1 here, we are told is an amount of 6 million, and then the net book value is 28. So therefore, we have the loss here, and actually for the loss, we take it as a negative. A loss is always a negative of 6 million, like that, which now will be equal to what? Which will be equal to the sales proceeds. Sales proceeds is what we are computing here. Sales proceeds, we don't have this one. Proceeds. Then to this, we less the net book value. The net book value, I hope you can recall, is a figure for how much? 28 million. I hope you can recall that figure. This one, 28 million. So therefore, we bring it here, 28 million. So what we need to do is basically to combine the right terms. So to compute these sales proceeds, the sales proceeds. So what do we need to do? We need to bring 28 on this side. And actually now it will be what? It will be what? It will be a positive. So therefore, we're going to have this one will be equal to negative 6, negative 6, and then plus 28. Plus 28. So that is basically how we are going to get the answer. So we can enter because this will be able to give us the answer directly. So we enter, and that now will give us 22. I hope you can see how we have computed this one. So we have taken negative 6, and then we have brought 28 on this other side as a positive. So and that now will give us a sales profit of what? Of 22. So that is the amount at which now our asset was sold at. So then from there, we have note number 2. We are given the depreciation of automatically the depreciation on PP. Does that require any working? No. So no working which is required here. So and then finally here we are told that shillings 50 million of the convertible loan stock was converted into ordinary shares at par value. So basically, if you come here, you'll be able to see we have loan stock. We are told some of the loan stock were converted into ordinary shares. So basically what that means is that loan stock having a value of 50 million, they were redeemed. And actually that's why you can see we have a decrease of 50. They were bought back by the company, but instead of the company paying cash or refunding cash to the holder of this particular loan stock, what the company did, it issued ordinary shares which had a value of 50 million. So meaning that if you check on the increase in the share capital has increased from 150 to 30. So in this case, you can see we have an increase of around, this is an increase of what? An increase of 80. So mean that there were some shares which now were issued to the holders of the loan stock, and basically no cash which was received in relation to those shares, but also here there were some shares which were issued in what? In cash. Maybe we can just have that working here. Like in this case, we are saying that the share capital increased from 150 to 230. So how much is that increase? It's basically an increase of 80. Let me put it like this, such that it will appear as an increase. We have 230 minus this one. So it's basically an increase of 80. But in this case, we are saying that out of these particular shares which were issued, shares having a value of 50 million, they were issued to the holders of loan stock. So meaning that no cash which was received in relation to these shares, no cash which was received here, no cash received. Because in this case, we are saying that these are the shares which were issued in exchange of the loan stock which were converted. So the difference here, we can just do auto sum here. The difference, these are the shares now which were issued by the company for what? For cash. So these are shares issued for cash. Issued for cash. And therefore, these are the shares we are going to consider in preparing our statement of cash flows. So the other shares now which were issued for 50 million, no money which was received in relation to those shares. Yes. So I think we are done with that, with this one, with the note number 3. But before we proceed to prepare the statement of cash flows, there is something here we have to prepare, and that is the PP account. Usually, you have to prepare this particular account, and equally, if you can remember the question we did yesterday, we prepared the PP account, and the main objective of preparing the PP account is to determine were there some PP which were acquired during the current year, because that is something in most of the cases the examiner will not have given you. So therefore, let's prepare the PP account, and then we proceed to prepare our statement of cash flow. So we prepare the PP account, and I think in this case we said whatever you can be able to copy from the question here, you don't have to type it. So we can just come down here and we copy this one, we highlight that, and then we say Control C, we bring it up here. Control V, Control V. Control V is to paste. Control C is to do what? Is to copy. So these are some of the shortcuts you need to get used to as we move forward. And then this is an account. Remember, in this case, what we said is that anytime you want to do some changes, to do some editing, so what you do, you come and highlight this one, and then it will appear up here. So you do the editing from here. If you decide to do it from here, it will basically bring some confusion. So you always do your editing up here. And remember, this is basically a ledger account. A ledger account in this case should have how many columns? 4. These the details column, the debit and the amount column on the debit side, the details column and the amount column on the credit side. So this maybe we can bolder this one. We can use these boulders here because these are ledger accounts. Yes, and basically because this is an asset account, what we start with on the debit side, we start by recording the balance brought down. The balance brought down. So the balance brought down is basically whatever you have here. So remember the from this statement of financial position, these balances for 2021 are the opening balances, whereas for 2022 are the closing. So the opening balance here is this one, 264. And then in this case, remember it said such an item which is already here, you don't have to type it. And then down here, we need to record the balance carried down. So I don't have to type that again. I can just copy this one. I say Control C and then Control V. And then because this should be balance carried down, I can do some editing up here. Yes, like that. Then I can make this to be a little bit bigger. So the balance carried down here is whatever you have here. So I just come here in this cell. I hope you can see what I'm doing. So the balance carried down, I'll come here and say this will be equal to, and then I highlight this cell, and then I do what? I enter. So my balance will automatically come up here. Then we said in preparing this particular account here, there are basically a number of items which we record in this account. For example, on the credit side, we record one, the depreciation for the current year. The depreciation for the current year. We also record disposal, the assets which might have been disposed by the company during the current year. On this side, what do we record? We record things like the acquisitions, the assets which were acquired. We also record things like the revaluation gain. In case there is a revaluation loss, we record it on the other side. Let me copy this. In case we have a revaluation loss, we record it on this other side. So this one will be a revaluation loss. Yes, and then from there, remember in our case, what we want to compute is this acquisition. Were there some assets which might have been acquired by the company during the current year? Because if you can recall, we're given most of these items. For example, you're given this depreciation. This depreciation, this figure is given somewhere in the addition information number what? Number 2, the depreciation for the current year is 42. And then also recall we have this asset which was disposed. which had a net book value of 28. So we need to record those two values. So 28 disposal and depreciation of 43. Depreciation here of 43, disposal 28. Then for you to check whether there was some asset which were revalued or not, what you do, you go to the equity section, and you check whether we have a revaluation reserve. In the equity section, do we have a revaluation reserve? Yes. So in the revaluation reserve, in this case, you can see it basically reduced. Is that the case? It reduced from 76 here to 36. So what causes this one to reduce? So the revaluation reserve will reduce because there was some either bonus issue, there were some shares which were issued free of charge, or there was a revaluation loss. So are we given any information about this one, about bonus issue? No. So therefore, in this case, let's first of all determine the revaluation loss. So this revaluation reduced from what? From 67 to 36. So we have a decrease of how much? So we take 67 minus this one, which is equal to 31, which is equal to 31, which is equal to 31. Now this one, because the question is silent, automatically we're going to assume it is a revaluation loss. But remember, in this case, I've said that this revaluation reserve can decrease due to a number of items. One is a bonus issue. Bonus issue is whereby the company issues shares free of charge to the existing shareholders, and the company pay for those shares using the revaluation reserve, or the company may have revalued some of the assets downward. There was a revaluation loss, and because the question is silent, then in this case, we assume that this was a revaluation loss. So the revaluation loss basically is the figure which you have computed here, which is a figure for 31, that one. Yes, 31. So then from there, I think on the debit side, automatically the revaluation gain will be 0. So what we need to do is to compute this one as a balancing figure. First of all, we get the total on the credit side. So we say auto sum, which will give us 429. And then we get the total on the debit, which will be 264. So you can see on the debit side is less. So mean that the balancing figure here will be the asset or the PP which were acquired, and that will be equal to 429 minus 264. So 429 minus 264. And automatically that will give us 165. So these are basically items of PP which were acquired during the current year. And I think with that now, we can proceed now and we prepare our statement of cash flow. So let me copy this particular title here. I don't have to keep on typing this. So maybe I just highlight that and then I pick whatever I want. I want just this one. Statement of cash flows for Bermuda as or for the year which ended 30th of June 2022. That is what I need. I just copy that. And then I bring it here. I say Control V. Yes, Control V. And then I can also make this one to be a little bit more clear by bolding it. I can bold it by Control B. Control B. Also, I need to have two columns here. And I hope you can see our figures are in million of shillings. Do I need to keep on typing at, do I have to type this one? No, I just come and copy this one, Control C. And then because I need to have two columns here, and then I can highlight the two columns. I say Control V, Control V. And then you can see, you can make your column to be a little bit bigger. So you can decide to come up there, you put it like that. Or I think you can just, yes, let's just put it like that. Or alternatively, there is another approach you can use here. I think you can just highlight this. And then you come up here, you say wrap the text. Wrap the text like this. Wrap the text. Sasa? Yes. wrap the text like that. Now here, I recall what we said is that in preparing the statement of cash flows, what we do is that we start by computing the cash flow from operating activities, operating activities, and then from there down here we compute something called the cash flow from investing activities. So in this case, I can just copy that one and then I bring it down here. Control V, and then this should be cash flow from investing activities. I hope you can see where I am doing my editing. I'm doing editing up there, and then still I can be able to copy this one. I copy this, Control C, and then I have it down here. So we don't have so many items here. So I think that's a space will be enough. Control V, and then this should be cash flow from financing activities. I enter, and equally I can make bold, make this to be more clear by bolding it. Can just highlight all this, and then I say Control B, Control B, Control B. Yes, like that. Now, when computing the cash flow from operating activities, recall here we said we always start with the profit before tax. That's what we start with, profit before tax. And the profit before tax, this one, where do we get it? We get it from the income statement. So what we do, we don't have to keep on typing that. So we will come here and we say that this one will be equal to, and then we go to the cell where we have the profit before tax, this one. We click this cell and then we do what? We enter. Our figure will automatically come there. And then we said we do a number of adjustments as far as this profit is concerned. We do a number of adjustments. So equally, we can border this one, Control B. And then we say the various adjustments which we make to this, we can use this acronym, dial G. D for depreciation, I for impairment loss on goodwill, A for amortization of intangible assets, L for loss on disposal, and then G for gain on disposal. So these are basically the items we need to check whether we have them. This will be the depreciation, and the depreciation on PP, this one is something we already have it, so we don't have to keep on typing this. So we just say that this one will be equal to, I think this one is in our account here, this one will be 43. So I just enter, and then I stand for impairment loss on goodwill. So basically what we do, goodwill, recall, is an non-current asset. So we go back here and we check, do we have goodwill? So here we don't have goodwill. So automatically it means that we don't have this impairment loss on goodwill. So then A here, this one stands for amortization of intangible assets, and this amortization of intangible assets, we equally come back here and we check, do we have some intangible assets? Yes. The intangible assets, you can see their value was 50, and then at the end of this 40. So we have a decrease. What causes the value for intangible assets to reduce? Two items. It can either be disposal or sale or amortization. But in case the company sold some asset, you must be given some information on that, because you must be given the sales profit and so on. So, but if you can recall in the addition information, we didn't have any, or we didn't have such information. So therefore, how much is the decrease? So let's compute this one. It will be 50 minus 40, and that will be 10. So therefore, the amortization on intangible assets will be this particular figure here. In this one, we enter. So then L here, this stands for loss on disposal, and I can record we have this one, loss on disposal. Loss on disposal, we have it as somewhere here. It was this particular figure of 6 million. So 6 million, I think we can just type it there. Yes. So, and actually we say that these first 4 items, depreciation, impairment, loss on goodwill, amortization of intangible assets, loss on disposal, all of them, we add them to this profit, because in arriving at this profit, they had been deducted as what? As an expense. And because they are non-cash items, that's why we add them back. Then in this case, G stands for gain on disposal. On disposal. Do we have this one? No, we don't have any gain, because the asset which was disposed, it was basically disposed at what? At a loss. So therefore, in our case, we don't have that. Yes. So basically, I think these are some of the items which we adjust now to the profit. And then from there, before now we move to the next item, we can go back to our statement of cash flows and we check whether we have any other item which will be adjusted in that profit. And I think we have, maybe starting with this investment income. Now, this investment income, this you can see in arriving at that profit, it has already been added. In arriving at this particular profit of 114, this investment income has already been added. But basically what we know is that this is not an income from operating activities. Basically, this is an income from investing what? Activity. So what we need to do, we need to less it from this profit because it has already been added here. How much is it? How much is it? It is basically a figure for 6. For 6. And because in this case, I need to less it from this. You can see here it's appearing as a positive. I need to make it as a negative. And we said we can come up here. I hope you can see what I've done. I've clicked that cell, highlighted that cell, and then the figure will appear there. Then what I need to do to convert it to a negative, I just need to multiply that with -1. -1. You can see now it's becoming negative what? 6. Then from there, we also have this particular gain on financial asset at fair value. Now, this particular gain on financial asset at fair value, this one is basically accounted for as an income, is usually accounted for as an income, but basically this is what? This is a non-cash item, is a non-cash item, is a non-cash item. So therefore, this one will also be adjusted here. So we bring it here. So, and the figure is what? Is 5. Is 5. Is 5 million. 5 million. Okay, I also need to make it a negative. So I multiply this with the -1. Yes. So basically it is now -5. Basically we are erasing that here from this profit because it has been added, but basically it is not an income from. It is not an income from. It is basically a non-cash item. It is basically a non-cash item, a non-cash item. So I think those are the other items. Yes, so maybe also from the workings, we can just check whether we have any other item to be adjusted to the profit. I think we have dealt with this loss. We have dealt with the, okay, here we had disposal. And then in the other notes, anything else to be adjusted in the profit, you have dealt with note 1, 2, 3. Yes, I don't think we have anything else. So what we need to do is basically to get the net amount here. So we basically add all this, we get an auto sum, which will come to 162. Yes, 162. Yes, 162. And this one is known as the cash flows before changes in working capital, before changes in working capital. Working capital. Yes, I hope we are together up to that point. Are we together up to that point? Are we together up to that point? Are we together up to that point? Sarah, tuko pamoja up to that point? Okay. So then here, what next do we consider? We consider now something called the changes in working capital. Just copy this one and then I bring it down here. Changes in working capital. And in this case, you have to recall that changes in working capital here, we consider three items. Receivables. Actually, you have to remember this RIP, receivables, inventory, payables. So this one, I can just put it as the receivables. Then this one will be inventory. And then this one will be what? Will be payables. So what we need to do is to determine, as far as these three items are concerned, was there an increase or decrease during the current year? So and actually we know inventory, receivables are items of current, assets, items of current assets. So let's come here. So for inventory, I can see at the start it was 176 to 123. This is basically what? A decrease. And what we do here, we just take the opening balance. We say the opening balance was this one, minus the closing balance, which is 53. So, sorry. I think that is the receivables. That was for inventory. So that was inventory, whatever you have considered, this one, minus, okay. So inventory, this one. So this we say will be equal to 176 minus this one. So this is basically a decrease. So a decrease in inventory means that this company sold inventory. So if the company sold inventory, automatically that is a cash inflow. So we need to do the same for receivables. Receivables at the start was 87. And basically that did what? Increased to 95. So decrease of, increase of 8. So what causes receivable to increase? Receivable, remember, is the amount of money which a business is expecting to receive from the debtors. So the reason why this amount increases is because there were some credit sales. There was goods which were sold on credit. There was outflow of an asset from the company. So that should be a negative. And then here still we consider payables. Payables is the part of the current liabilities. So we go to where we have current liabilities. And the current liabilities, what do we have here? We are checking for payables. Payables at the start was 100, and basically that increased to 156. Payables, remember, is the amount of money which a company expects to pay the suppliers. What causes that amount of money to increase? It increases because the company made additional credit purchases. So if the company made additional credit purchases, it basically means that is an inflow. That is what? Inflow of goods. So therefore, being an inflow, this should be a positive. To make it a positive, I just multiply that with a -1. So this is something you need to recall, basically from financial reporting, how to determine whether an increase or decrease in those three items, whether it is an inflow or what? Outflow. So those are the three items which we consider. I need to create more space here, so I need to move this a little bit down here. So I'll basically do what? Highlight everything here, and then I need to cut it, not to copy. I need to cut it, to move it. I say Control X. Control X is to cut, and then I bring it down here, where I will say Control V. Yes. So basically that is it. Then I think we have two items now which are remaining here. One is we less the tax paid. We less the tax paid. and then we also less. We less the interest. We less the interest. We less the interest paid. We less the interest paid. Interest paid. Tax paid. Interest paid. So I think we can start by determining the tax which was paid. Now, for the tax which was paid, and actually the computation of this is just the same we were doing in financial reporting. So you come here and you check, do you have deferred tax? In our case, we don't have deferred tax. So then here we must be having current tax. So, and remember, maybe whatever you have dealt with, you can just highlight it. We have dealt with this one, so maybe you can just highlight it. So we have these tax here. So this is basically what we are going to use in computing the tax paid. So how do we compute the tax paid? Remember, this is the tax the company was supposed to pay at the start, and this one at the end of the year. And then in the income statement, we must have the tax expense, this one. So we may decide to prepare a ledger account, a ledger accounts, or alternatively, we may decide to use a direct approach of computing this tax paid. Let me show you how we compute the tax paid directly. So what we do, we take the tax which the company had not paid at the start, the tax which are not being paid at the start. So this is the tax the company had not paid at the start. And then to this, we add basically, I've already typed the add, the addition function here, add the tax for the current financial year. How much tax was our company supposed to pay during the current year? Whatever you have here, 47. And because this is basically a negative, I can just type it here manually because it should be a positive. So I'll just type it manually, 47. And then to this, I minus or I less the tax which are not being paid at the end of the year. So the tax which are not being paid at the end of the year, in this case, is 19. So I hope you can see what I've done. I've taken the tax the company was supposed to pay at the start, 34. I have added the tax payable during the current year from the income statement, 47, and then I have deducted the tax not yet paid at the end of the year. So that's basically how we compute the tax paid. And then what I need to do? I need to enter that one. But remember, this tax paid, this is a cash outflow. So what I need to do, I need to make this tax paid as a negative here. I'll have to multiply this one with the -1. And then I enter to make it a negative because it's a cash outflow. It's a cash outflow. Now for the interest paid, we do the same. So we go to the current liabilities. Current liabilities, we have something called the interest payable. This is basically the interest the company was supposed to pay at the start and also at the end. So I'll take this one, 3, and then I will add. I will say shift plus. I hope you can be able to see that function in your calculator, maybe in your laptop. So plus I add the interest or the finance cost from the income statement, this one, which is 17. And there is something we forgot up there. We will be able to adjust it. We didn't add this finance cost back in our profit. So we will have to go back there and adjust it there. So we add this one, and then we minus the interest payable at the end, this one. Let's go back to our working here. You'll be able to see whatever you have, what we have done. I think there is something which has not been captured. We have taken E45 plus C45. Let me redo it again. So we are saying that this one will be equal to the interest payable at the start. And then to this, we add the interest. And actually, you can confirm whatever we are doing up here. We add the finance cost, this one, and then minus the interest payable at the end. I hope you can see our formula up there. Up here, this is where we have our formula. We have taken the interest payable at the start plus the finance cost in the income statement minus the interest payable at the end. We enter we enter. That will give us 13. But because this the interest paid is a cash outflow, equally we need to make this to be a negative, negative, or in other terms, we record it as a cash outflow by multiplying that with -1, -1. Yes. So that is it. That is basically what we consider here. There is something I'm saying we forgot to do here. To this particular profit, we forgot to add back the finance cost. And actually, we said that should always be the first adjustment here. That is always the first adjustment here. That once you have recorded the profit, you basically need to go ahead and you do what? You add back the finance cost. So that is something we forgot. That's why I need to insert an additional row here. So I need to move this upward here. I say Control X, Control V. And then I have this finance cost. This finance cost, this basically need to be added back to that profit so that we have the profit before interest and tax. I say Control C, I copy, and then I paste it here, Control V. Control V, the amount is how much? I just need to enter that. I'll basically take the figure directly here, is 17. So basically we need to do some adjustments here. Let me recompute this afresh. Auto sum, it will be on 79. Yes, and I think we are done here, and then we add all this. Yes, we get 205 here. So this 205 is what? This one we refer to it as the net cash flow. Net cash flow from operating activities. From operating activities. I can also make this one a little bit clear. I bold it. So Control B. Yes, like that. Okay, so I think we are done with the first section of our statement of cash flows. So what we need to do is basically proceed down here and we record the various investing activity items. Remember, in this case, when we talk about investing activities, these are those particular activities involving acquisition of assets and sale of assets. Equally, what we also consider here is any income which was generated from investment. I think maybe even before we consider the asset which were acquired, the asset which was disposed, we had this investment income. So we copy this one, we bring it here. Remember what we have said is that the reason why we have deducted this investment income from our profit is because it is added in the profit, but is it an income generated from operating activities? No. So, and remember here, what we needed to compute is the cash generated from operating. So we do what? We less it from the profit and then we consider that here because this is money generated or is an income generated from investing activities. And actually, these are cash inflow, but it's always advisable as far as this investment income is concerned, you come to where we have the current asset here and basically you check whether there is interest receivable. If you can remember the question we did yesterday, we had an interest received, but also here we had interest receivable. So what we were able to do, we computed the actual amount of interest which was received, but in our case, we don't have that. So the other item which we also consider here is acquisition of PPE. And I hope you can be able to recall from the account we prepared, we were able to see that there are some items of PPE which were acquired. So from the PPE account we prepared up here. So the PPE acquired had a value of 164. So, but recall acquisition of asset is a cash outflow. So what do we have to do? We have to make this to be a negative by multiplying that with a -1. So we have that. Then equally, there was disposal of assets. As per the addition information number 1, there was a disposal of assets. And actually what we consider here is the sales proceeds. So this asset which was disposed, it was sold at an amount of how much? That is basically what we consider here. And I think we have already computed that amount in working one up here. It was 22. So we just enter that amount, and that is a cash inflow. So do you have anything else to be considered here? Maybe you can check from where we have assets. So we have dealt with this PPE. We have dealt with this item of PPE, this one. We have also dealt with intangible assets, because this one we say decrease is amortization. What about this financial asset? Now for the financial asset, they increase from 10 to 22. So we have an increase of what? An increase of 12. Now what causes this value to increase? Two main reasons. One, it can be caused by acquisition or basically purchase of additional financial asset, because this financial asset is basically investment in shares, or it can be occasioned by a revaluation gain. It can be occasioned by a revaluation gain. And I hope you can recall under the equity section, we had something called the financial assets through other comprehensive equity reserve. In other terms, this is a revaluation reserve relating to these particular assets here. You can see at the start of the year it was 0, but it increased to 2. So meaning that these particular assets here were revalued upward with an amount of 2 million. They were revalued upward with an amount of 2 million. So meaning that this particular increase of 12 is occasioned by the revaluation gain of 2 million and the acquisition. So basically what we need to do is to determine the financial asset which were acquired, which automatically would be the difference between these two values here. The difference, 10 million. So these are the financial assets which were acquired. And that is what you're going to take to our statement of cash flows, specifically at the investing activity. So equally, I need to create some space here. So what I need to do is to cut this one. I say Control X, and then I bring it down here, Control V. So we say there was acquisition of financial assets at fair value through other comprehensive income. That is the short form for that. Financial asset at fair value through other comprehensive income. Through other comprehensive income. So basically, the increase here we have said is what? The increase is 10. So we just enter it here. And remember acquisition here. This one is what? Is automatically a cash outflow. So we need to basically record it here as a negative. And I think we don't have anything else here to be considered. I don't think we have anything else to be considered here, because I think let's go back here where we have assets. So yes, I think we have dealt with yes. So we have dealt with all this. So I think what we basically need to do is now to get the net amount here. The net amount. So this will be equal to this plus this plus this plus this, and basically we do what? We enter. So we are getting a net cash outflow of 147. Then finally here we need to determine the cash flow from financing activities. And recall what we said is that all the items which we record here, we get them from equity and the non-current liability section. That's where we get all the items which we include here. So let's go to where we have the equity section. Equity section, we have ordinary share capital, which increased with 80. And I think you can remember this working which we did, an increase of 80. But we said that this increase is caused by two items. One, we have the shares which were issued by the company as a result of this, or to the holders of this loan stock, which were redeemed, because you can see the loan stock reduced by 50. They were redeemed, they were bought back, but instead of the company paying cash, the company issued shares. So therefore, we said no money was received in relation to this. So the shares now which were issued for cash, that is now what we consider here in our statement of cash flow. Issue of ordinary shares. We only consider the shares which were only issued for cash. Because when preparing the statement of cash flow, we don't consider the non-cash transactions. We only consider the cash transactions. So the issue of ordinary shares, this one would be equal to 30. We enter. So then from there we have the share premium. The share premium also increased with 30. So automatically this is due to the shares which were issued. They were issued at a premium, increase of a share premium. Increase of share premium, which is basically 30. Which is 30. I can just enter this figure here. 30. Yes, so just give me like 2 minutes, please. 2 minutes. Okay, so let's continue. I want us we wind up with what is remaining. So in this case, we are determining the cash flow from financing activities. We have said we get all these items from equity section and non-current liability section. I think we have already dealt with the share capital. The share capital, let's go to the equity section here. So we have dealt with the share capital, the share premium. We have dealt with those two. And then we have the revaluation reserve. I think we dealt with this one when we were preparing the PP account. We said there was a loss. And then this one we have dealt with it in relation to financial asset at fair value through other comprehensive income. Then for these retained earnings, if we can remember the question we did yesterday, we say that we use this one in computing the dividends which were paid. How do we compute the dividends paid by the company? Let's come here and we compute the dividends paid. Dividends are paid by the company. So to compute the dividends paid generally, I can have that formula for you here. We take the retained earnings at the start, the retained earnings of the company at the start of the year, and then to this we add what? We add the company's profit after tax, and then to this we less the retained earnings at the end of the year. At the end of the year. That basically will give you the dividends which were paid. So let's do that. We take the retained earnings at the start, this one, plus the profit after tax. That one automatically is in the income statement. Profit after tax, which is this one, 67 minus the retained earnings at the end, this one, 122. And that will give us what? That will give us 37. That will give us 37. But recall in this case, dividends paid is basically a cash outflow. So if it is a cash outflow, I must record it in my statement of cash flows as a negative. As a negative. I need to multiply this with the negative one like that. Yes. So that will give us that is what? It will give us 37. So that is it. We are also done with this one. We are also done with this one. This one. So then we go to the non-current liability section, and I think here, whatever you have, we have already dealt with this one, because I hope you can remember that this decrease from 150 to 100, these are their own stock which were redeemed, and the company issued some shares in exchange. So meaning that this is a non-cash transaction. Non-cash transaction, which automatically we don't consider in our statement of cash flow, which we don't consider in our statement of cash flow. I think majorly we are done. What we need to do, we need to get now the net cash flow from financing activities, basically by adding these three figures here. Adding these three figures here. And basically we add those three figures. And then from there we get something called the net changes. Net changes changes in cash and cash equivalents, cash and cash equivalents. So this one we computed by adding this, and this. So, and because these figures, you see these figures, they have a formula. So it is not possible for you to come and add them down like this, because they have some formulas. So basically what you do, you can just type them manually. So you say this will be equal to 205, which is up there, plus, or basically minus 147, and then plus 23, plus 23. So this will basically give us 81, which is a positive. And then to this, what do we add? We add cash and cash equivalents at the start. Cash and cash equivalents, that is cash and cash equivalents. Cash and cash equivalent, let me do my editing up there. Equivalents balance brought down, which is basically at the start of the year. And how do we determine this one? So to determine the cash and cash equivalent at the start of the year, basically we add a number of items: cash in hand, cash at bank, bank overdraft, and any short-term investment at the start. So therefore, what we do, we go to where we have current assets. Current assets, here we have cash and cash equivalent, this one. At the start of the year, it was 0. It was 0. And then to this, what do we add? You see this particular financial asset at fair value. This is also a short-term investment. These are short-term investment. So it is also considered as part of the cash and cash equivalent. So to this, we add 30. And then we less the overdraft. Do we have an overdraft here? Yes, minus 22, this one. I hope you can see what we have done. We have taken cash of 0, short-term investment of 30, and then minus 22. So what do we need to do then? We enter, which will basically give us 8. And then we add this, we see whether it will be able, it will reconcile with the cash and cash equivalent at the end. So we control C, we control V. So this will be cash and cash equivalent balance carried down. So we need to confirm So because this should be the same with the cash and cash equivalent at the end of the year as per our statement of financial position. So we take what? We take this 65 plus this one plus this one. Yes, 65 plus this one. We enter. It's coming to what? It's coming to 94. Yes, we have a difference of what? What is the difference here? The difference is this minus whatever you have here. The difference is 5. The difference is 5. Yes, that is something. Let me check that one. It should, because this one should be 94. This one should be 94. Let me see. Do we have a figure for 5? A figure for 5 million? Yes. I can see it here. So the problem which is here is this particular gain. So the gain on financial assets. So this one should not be adjusted because we are dealing with which gain? We are dealing with which financial assets? We are dealing with short term. Yes. So this one basically should not be adjusted here because that change of 5 million is always captured down here. Whenever we are considering the cash and cash equivalent, that change in the financial asset at fair value of 5 is always captured here. So therefore, I think the figure which was not supposed to be included here is this particular gain, the gain. So actually the gain now which we adjust here should be for the other financial assets. So this one should not be here. Let me see whether the figure will automatically adjust itself. Okay, so we need to do some changes here. So, but that should be the case. So that gain on short-term financial asset should not be captured here. Let me cut this one. And then I paste it up here. I paste it up there. And I can also recompute it afresh. It will come to 184. And then I need also to recompute this afresh. 210. And then whatever you have here, we need to compute it afresh. It will be equal to 210 minus 147 and then plus 23. Plus 23, yes, it's coming to 86. And then we add the cash and cash equivalent at the start of the year, which is basically 8. Yes, so I think that is correct now. Yes, so I think that was the problem, or basically that was the small error which we had done of adjusting that particular revaluation gain of 5 million here. It should not be adjusted because I've said that financial asset at fair value, which is a short-term investment, we have said that change is captured down here within the opening cash and cash equivalent and closing cash and cash what? Equivalent. So therefore, that is it. That basically what is required as far as that question is concerned. A question for cash flow. Yes, I hope you have understood something. Sarah, can you be able to handle that question now using Excel on your own? Yes or no? Yes, so I think what basically I will be able to, I will do, because I think we have done 2 questions. We have done the one for August 2024, and actually the one for 2022. There is this other question, I think, which I'll give as an assignment. I think this one we said was for another sitting. I'll be able to confirm, to counter check. So you basically attempt this one. And then once we meet in our next session, we will be able to move to something else. And basically what is required of you as far as this paper is concerned is a lot of exercise. I hope by now you have maybe procured a laptop so that now you can start doing some exercise. You can start doing some exercise. Is that the case?